How's everybody doing? Doing good? All right. So this was something that was shared with me by, I didn't create this slideshow, just full disclosure. I got it from a guy that won the Crystal Ball Award from Zillow for the past 3 years and where the market's going. So I found it fairly informational and wanted to share with everybody. So 2021 recap. Interest rates. The forecast is we expect interest rates to rise at the beginning of the year and recover into the fall. Actual rates did rise sharply through March, as anticipated, but recovered a bit earlier than we expected, gaining back most losses by late summer. Late summer to fall, rates were pretty low again. Housing. The forecast for housing was strong demand, tight supply will push home prices up single-digit percentage. In actuality, there was strong demand and tight supply, but COVID caused supply chain disruptions and labor shortages, which pushed real estate values even higher than our robust forecast. So 2020 was a $4 trillion real estate market in the United States. 2021 was 4.1 trillion. 2022 is expected to be 2.6 trillion. 2.6 trillion is the third best year in the past 15 years. So while it sounds like a big drop-off, in the past 15 years, it's the third best year of the past 15 years. So some 2022 dynamics. The Fed will play a major role in 2022. Tapering, which means the Fed, without getting too technical, they buy mortgage-backed securities, which drives rates down. They're going to stop buying mortgage-backed securities, which is going to push rates up, right? So that's called tapering. There's going to be some rate hikes between 4 and 6, and they're going to let some of the assets run off the balance sheet. This can impact equity markets, drive interest rates up, impact housing as well as jobs. Some Fed voting members rotate each year, so not all, if you're on the board of governors, not everybody's a voting member. 2022 composition will be less accommodative than 2021. About a week ago, the new Fed governor out of San Francisco was very hawkish on inflation, and the whole market changed for the day. Dow was down 600, rates still low. She's a new voting member. I don't think she was necessarily conscientious of how her words could impact things. Fighting inflation is a main focus. Although if you ask John, he's all for it.
Yeah. I got a lot of debt. I got a lot of assets. Like, you know, the amount of real estate I own dwarfs what I pay in gas. So you know, I'd rather have inflation on real assets and worry about it later.
The Fed should have hiked rates sooner. Mistakenly, though inflation was transitory, it's not transitory. History can help us forecast how the Fed's actions in 2022 will influence the markets. And I think this is really the best, right? History is the best prediction of the future, right? So, Arthur Burns was the Fed chair in the 70s. He ignored inflation, which was rising rapidly, insisted inflation would be transitory. Sound familiar? Year-over-year inflation ballooned from 7% in 1978, which is pretty much where it is for us today, to 14% 2 years later, in 1980. Higher inflation caused mortgage rates to rise from 12 to 18%. 1980, Paul Volcker fights inflation. He was really hawkish. He did a phenomenal job if you go back and look at what he did. He hiked the federal funds rate from 11 to 20% in 2 years. It was a little bit of pain there, right? But inflation dropped from 14 to below 5. Because inflation dropped, mortgage rates sharply declined from 18 towards 12%. Anyone want a 12% mortgage? But there were consequences. The S&P 500 sharply declined by 30% during this time. Tighter monetary policy pushed the U.S. into a recession in 1982. We've all been through recessions. The definition of a recession is negative GDP for 2 consecutive quarters. Negative GDP can be 0.1% for back-to-back quarters. They're really not. Everybody's making money at some point. In the late 90s, inflation doubled from 1.75 to 3.5. Higher inflation caused mortgage rates to rise from 7 to 8.5. Unlike Burns, Greenspan took action in 1999 and hiked the federal funds rate by 1.75%, matching the inflation rate from 4.75 to 6.5 in a year. Greenspan was a good Fed governor, Fed chair. Inflation responded and dropped from 3.5 towards 1%. Mortgage rates dropped from 8.5 to 5.5, sparking a huge refi boom. Right, if you have 8.5 and it goes to 5.5, you're gonna refinance, right? But again, consequences. S&P fell 500 points. S&P 500 fell by 50% by the spring and fall of 2000. The U.S. entered a recession in 2001. So today, under Jerome Powell, 2021 inflation increased from 1.75 to 7% under this man. Powell thought it was transitory. Higher inflation caused mortgage rates to rise from 2.5 to not 3.375. Fed is currently tapering the purchases of mortgage bonds and treasuries, will not hike and reduce purchases at this time. Done tapering in March, likely to begin hiking in May. That's already priced in. The market, rate cuts and rate hikes don't wait for the day for the Fed to do it. It happens well in advance. The day that the traders decide which way it's going to go is when it goes that way. Doesn't happen that day. Fed is targeting 3 rate hikes in 2022 and 2 or 3 more in 2023. Inflation and interest rates can still rise until the Fed acts. If the Fed can tame inflation, more rates should drop, but may be from higher levels. So, recap. Burns and Volcker. Inflation was 7 to 14%. Mortgage rates from 12 to 18%. Fed funds rate went from 11 to 20. Inflation response was 14 to 5. S&P down 30% when we went into a recession. But ultimately, what happened is rates went down. Greenspan. Inflation was from 1 3/4 to 3.5. Rates went from 7 to 8.5. Fed funds rate went up from 4.75 to 6.5. Inflation response was 3.5 to 1. Rates again went down. 8.5 to 5.5. Jerome Powell. Really amazing. 1.75 to 7%. 2.5 to 3.375. 0 to 1%. The jury's still out. Should drop. The rate should decline. Stocks are expensive and the economy is slowing. Are we going to hit a recession? It's to be determined. Who knows? There are some wild cards. COVID plays a major influence on monetary policy and supply chains. If we get a major surprise in COVID, it could change the outlook dramatically. Additional stimulus would fan the flames of inflation. You can't have any more stimulus. It's going to kill things. This would push stock prices temporarily higher, cause mortgage rates to rise further, and make the Fed's job of corralling inflation more difficult. Run off the Fed's balance sheet. The first step, the Fed's to stop purchasing mortgage bonds and treasuries. Next step is hiking the Fed's funds rate. Right now, the Fed is still buying $70 billion in a month in mortgage bonds through reinvestments and keeping rates low. If or when the Fed stops reinvesting, mortgage rates could move higher than previously thought. This is a stock market forecast. Saying the median price earnings extremely overvalued. Price to gap earnings. You go right down the whole list. They're all pretty much extremely overvalued right now. Rate hikes could cause P&E multiple contraction, resulting in lower stock prices, as seen in the past. Forecast a 10% decline in the major indices in 2022, which is a good thing. Corrections are healthy. Housing forecast. Housing will remain strong in 2022, but not as strong as 2021. Again, 2.6 trillion for the USA in 2022. Third best year all time on record. Demand may be slightly softer due to a rise in interest rates, but still robust. Supply will increase but remain tight. Tight labor, supply chain disruptions, semiconductor shortages will all play a role. Comes down to the jobs market too. The jobs, what's different about this market right now versus 08, I had my own mortgage brokerage in 08. Nobody was working. Everybody was out of work back then. And there weren't even jobs to go to. Right now you can't fill the jobs, right? There's more job openings than we have people to fill them. But people aren't, they're just, I don't know, either they don't like or want the job, or it's not the opportunity that they're looking for. But that's going to be the real difference maker in this time around, where they're going to be raising interest rates. Rents will continue to rise. Increases will remain above 5%, pushing many people to see the benefit of buying. Forecast is mid to high single-digit appreciation, still providing a great wealth creation opportunity. Thanks for coming. Anybody have any questions about loans, mortgages, FHA, conventional, low down, VA, traditional stuff? It's really not as bad as Anna said.
What's the current?
Go ahead.
So you mentioned, and maybe I understood it wrong, but we got rates that are going up right now, but you're saying if he's enacting these, rates should be coming down.
Follow the inflation rate. If you see the inflation rate start to turn downward, get excited. That means rates are going to turn downward. Rates are going to follow inflation. Right now, inflation's doing what? When inflation does...
What's the time frame you think though when that lags?
Do you want to go to Vegas? Honestly, I think rates are going to peak in the fall. I think they're going to peak in the fall because they're going to give us the spring market, and then everybody's going to kind of have their summer. You know, there's really two real estate markets throughout the year: the spring and fall. You know, winter's its own animal, summer's its own animal. But I think fall will probably see the peak. I could be wrong. I've been wrong before. Anybody else?
What are the current FHA rates right now?
Today was 5.25.
Is that up or down?
That's up. It's up. Yeah, it's up. Yeah. Oh, Toto, shut up. You got 8% when you first started buying. Jesus Christ. Spoiled brat. Hey, what's up?
So you seem to be fairly anti-Paul Volcker, but did he have to do what he did to because of the 70s stagflation?
No, I'm pro Volcker. I'm a Volcker advocate. He had the balls to do what needed to get done. Unlike Powell right now, who just can't pull the trigger.
And if he did what Volcker did, wouldn't that put interest rates at like 26%?
It's relative. He wouldn't necessarily hike to 20, right? We're not there. But I think maybe a more appropriate hike than, look, we've been at 0% rates for All right, we were at 1% under almost all of Obama, okay? And 0 since COVID. So that's almost 13 years. And we still haven't have the same problems that Japan had with 0% interest rates, luckily. Okay? So I think that a more appropriate response would be, more measured appropriate response would be called for. He doesn't have to go to 20 because we're not at 20, right? But he could have done more than a quarter. I mean, Jesus Christ.
I agree.
Just so everybody, here's where I am with this, right? If you have a Band-Aid, do you want them to pull it off slow or rip it off? Anybody?
Rip it off.
Fucking rip it off. Let's go. Right? The sooner they address it, the sooner we can get back to normal. The sooner inflation's going down, right? Rates are going to come back down. So even if they spiked up for 6 months and we're down for another 12 or 18, we're still in the green. I just want them to rip off the Band-Aid. I don't want them to do it slow.
Yeah,
That's just me.
I agree.
Go ahead.
How common are NACA loans?
I'm sorry?
How common are NACA loans?
NACA loans? Oh my
NACA.
God. Just shoot yourself. Just honestly, just fucking shoot yourself. There couldn't be a more pain in the ass loan in the world. It's good if you don't mind waiting a year.
Sorry.
What is it? Tell us about it.
I don't know. Look, all I know is that there's some sort of nonprofit which right there tells you what's going on, and when people are just aren't incentivized to do their job and they're just paid an hourly rate, you get what you pay for.
Government?
Yeah.
Yeah.
So you get what you pay for.
So I've never done an NACA loan. I think someone pulled like multifamilies, the percentage of things that have been sold by loan type, and I think NACA in Massachusetts was like 0.1% of like the overall bar. Like VA was like single digits, less than 5, but like NACA was like it was on the chart, but it was like 0. It's a very difficult loan, takes a very long time to do it, and then most of the time if they see it on the pre-approval letter, I mean most real estate agents kind of run scared because like it just has a bad reputation of taking a very long time.
Okay, thank you.
I had a buddy that used one in Boston, I think 2018, and it took him like, I want to say 14 months to close.
And so me as the listing agent, I'm like, accept any other offer.
Do you guys do anything with DCR loans, like where you don't need to necessarily have a W-2? If I'm like over $1 million in debt and don't have a day job.
I dabble in non-QM. I'm not really good at it, to be honest with you, because I don't do a lot of it.
Okay.
I do a lot of, FHA stuff, government loans,
Yeah.
like fixer-upper type stuff. Like, and that's whether you want to live in it or not.
Okay.
So, but if you wanted to buy a 4-family that's completely fucked up and you want to fix it up, I'm your guy.
And without owner occupying, no?
No,
You need a
because
status.
I'm more like 3.5% down, no money down type stuff.
Yeah. Okay.
What you're talking about is 25% down, and that's actually going to go up. Those down as the market tightens, the first thing that happens is credit policy tightens.
Yeah.
So down payments will increase,
Yeah.
FICO score requirements will go up, reserves will go from 6 to 12 months. You'll see that whole non-QM space
Yeah.
pucker up. It's going to happen.
Okay.
If it hasn't happened already, it's going to.
Yeah.
Do you see anything in the future or current with regard to cryptocurrency being involved in?
So that's more of a niche market. There is some stuff actually currently happening with crypto. A couple of guys in Canada actually, where they're doing 50% loan to value based on your crypto accounts. But that I know really nothing to speak in an educated format about it. I just heard they were doing 50% down.
Is that anything that you might guess on projectedly in the future?
You mean like traditional mortgages, like what I do?
Yeah.
The government's not really quick to move unless there's money in it for them. Right? So they would have to be incentivized to move quickly to get some money in it. Anyone else?
Awesome, thank you, Joe.